Hey guys, how's it going? Lewis Hardigan this here, welcome back to my channel, and in today's video I'm going to be analysing Diageo stock. I'll be using fundamental analysis to see if the company is worth buying or not. I'll then be using a DCF valuation to determine the fair value of their stock. Let's get straight into it. So who are Diageo? So Diageo plc is a British multinational beverage alcohol company with its headquarters in London, England. It operates in more than 180 countries and produces more than 140 sites around the world. It was the world's largest distiller before it was overtaken by a Chinese company in 2017. It is a major distributor of spirits and the world's largest producer of Scotch whisky. Diageo has a primary listing on the London Stock Exchange and it is a constituent of the FTSE 100 index. So let's have a look at the sales summary for Diageo. So spirits make up the majority of their sales, alongside you've got beer and then you've got ready to drink as well. But yeah, spirits make up the vast majority of Diageo's sales. Sales per region, so the United States make up the majority of their sales, and then it's broken down into various other regions such as other Europe and Turkey, Asia and Pacific, Africa, and then you've got the rest of them broken down there. So yeah, they've got a diverse revenue split around the world, so they're clearly a very global business. Now onto the income statement, and all of this data is from macro trends and it is in US dollars. So let's have a look at the top line revenue. So from 2017 to 2021, this has gone up, which is absolutely fantastic, which is what you want to see over time. Year in 2020 had a little bit of a dip, which is likely due to the COVID pandemic. Then looking at net income, yes, it is up over the past 5 years, but not by much. So yeah, you want the net income to be looking a lot more like 2019 and 2018's figures and going up over time. Now onto the balance sheet, and the main two figures I look for on here is the long-term debt to start with, and unfortunately over the past 5 years this has increased by over double, so that is a little bit of a concern, not good. Unless they've made a good acquisition with it, you want to know why they're issuing long-term debt like this. But then looking at the returned earnings figure, unfortunately this has gone down as well. So yeah, you'll have to have a look into that and see what the crack is there. Now let's have a look at the cash flow statement, and over the past 5 years, yes, you can see cash flow from operating activities has gone up, which is fantastic. And then alongside this, if you minus for capex, that means free cash flow has definitely gone up over time, which is really, really good to see and what you want over time for a business. Then let's have a look at the debt and the dividends paid out. So yeah, as we saw from before, long-term debt was issued. Yeah, in 2019 and 2018 it was a little bit, but then you can see in 2020 a large amount was issued due to COVID. So yeah, hopefully this doesn't continue over time. But then yeah, you can see, which is really good, is the dividends are being paid, increasing year on year. Dividends paid out are increasing, so that's a good sign. A business that can increase its dividends year on year, it will add your returns over time, so really good stuff. Now let's have a look at the key financial ratios for Diageo, and start with the current ratio. Very, very strong position. Yeah, that is very strong for a company like this. Long-term debt to capital, it's looking a little bit on the high side, but as you can see over the past few years it has crept up ever so slightly. You want this to stay the same or be going down preferably. And then yeah, looking at the gross margins and net margins, they are very, very juicy indeed, especially them net margins over 20%, awesome to see. And then yeah, return on equity is also very good for this business. I like to see above 15%, but it absolutely smashes it. So yeah, decent stuff from the key financial ratios. Now let's have a look at the genuine impact stats for Diageo, and we'll start with the quality metrics. So yeah, the profitability is very high, which is really, really good to see. But unfortunately the financial strength is a bit weak, likely due to the long-term debt situation. Capital allocation is sound, dividends are going up, but the debt is going up as well. So yeah, it's a bit of a, come see, come sell, that one, not too sure. Value-wise, income statement, expensive, balance sheet expensive. Yeah, it's looking a bit overpriced on the metrics for sure. We'll see what my valuation is in a bit, but don't get your hopes up. Growth metrics, revenue is solid, and then everything else is high, so that is really good to see. And a business of this size, scoring high is only a positive really. So some interesting insights there from Genuine Impact. Now let's have a look at my analysis checklist for Diageo plc, and the market cap of this business is $119 billion. That's taken from Google Finance. It's actually £89 billion, so still a very big UK business, one of the biggest on the FTSE. It's got a current price of £37, and yeah, a PE of 33. Anyway, onto the first pillar. So gross profit and net profit are very juicy, absolutely smashed my expectations, what I like to see. So that's very much in the green. Return on equity as well is very solid. Also something I really love to see in a business. Unfortunately, the long-term debt to equity situation is a little bit high for my liking. Hopefully they can grow out of it or pay this back over time. The current ratio is well above 1 as well, so liquidity issues are probably not going to be a problem. Proven ability to grow, so yeah, revenue and net income have grown over 5 years. Awesome stuff. Shareholder equity is down, which is not a good sign of course, but free cash flow is up. So yeah, that is an awesome sign that this business can still grow even it is a big business. Great capital allocation, so unfortunately they have issued a bit of long-term debt, which this correlates to the long-term debt to equity being a bit high, but otherwise it's looking fairly decent. Dividend growth over this time, and a small decrease in share count, and some decent acquisitions along the way. But unfortunately, we always like to buy at a fair price over at Lewis Harding Invest. But Diageo, I don't believe it is at a fair price. A PE ratio of 33 and a price to free cash flow ratio of 29. A little bit steep, to be fair, for a business this size and the growth rates. And for a 10% return, I'm looking at a share price of around £16 per share, which would mean the share price would have to fall 56%. So I think this just summarises it's a very good business, a fairly decent business, maybe a slight bit much debt, but that's something you can cope with if it is a really good business. But the red flag is the valuation. But let's have a look at my DCF and see how we got to them figures. Now onto the DCF valuation for Diageo, and I have taken these 3 cash flow estimates from Market Screener, and my required rate of return is 10%, and it is spitting out a share price of around £16 per share. So you may think this is a bit unreasonable, but weirder things happen in the stock market. 50% crashes can happen, and if it does happen, then it could be a decent buying opportunity. Yeah, well, I'll have a chat with you about my thoughts on this business, but it's just looking a bit overvalued, isn't it, really? So what are my thoughts on Diageo? So I think you know what I'm going to say here, but Diageo is a fantastic business, really profitable, high returns on capital, a manageable debt load, which it isn't too high in the grand scheme of things. Could be better, but could be a lot worse as well. But it's overvalued, unfortunately. For me to buy this stock, it would have to drop by over 50%. In the COVID crash, it did drop to £20 per share, which was fairly, close to where the share price would have to be for me to buy. But yeah, put it simply, great business, but it's overvalued. Like many stock on the stock market right now, in my opinion. There's a lot of great quality companies out there, but a lot of them are just trading at unreasonable valuations for me to get an appropriate return. I like to get a 10% return, annually on what stocks I own, so that would be over time, of course. But anything below that is inadequate in my opinion. If I can invest in an ETF, an index fund, and get anywhere from about 7 to 10%, depending if it's a world index or a US index, I need to be having a bit of a premium when I'm, investing in stocks. So it's basically that. Great business, but it's overpriced. Not much else to say apart from that. But yeah, if you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.